Hello friends. Welcome to SS Awareness Creation. Our channel is dedicated to spreading awareness on all things useful to wealth creation and finance. In this video, we are going to learn mutual fund versus stock. Where should you invest? Fluctuating interest rates and rising inflation have forced people around the world to search for different wealth management sectors. Equity stocks and mutual funds are some of the most popular investment choices. There is quite a bit of difference between the two, and this video will highlight the key features, merits, and demerits of each. What are equity stocks? Equity stocks represent partial ownership or share of a company. The benefits of positive company performances are reflected in the shareholders' account as dividends, bonuses, or others. The stock valuation also rises, meaning shareowners can sell their holdings at a price higher than their purchase price or profit from it. What is a mutual fund? Mutual funds are pooled investments comprising shares of multiple assets. Countless mutual funds also include bonds and debt funds in the mix to avoid the risk profile. Purchasing mutual fund shares allow the investor to allocate their assets across multiple stocks, offering affordable options for asset diversification. What should you choose? The dilemma of choosing between stocks or mutual funds is not uncommon. There are no absolute right or wrong responses between these. The subject is rather subjective and depends upon the investor's preferences. In the case of stock equities, the choice of picking the equity stocks lies entirely upon the investor. For mutual funds, investors pool their assets into the hands of the fund manager, who takes the call on their behalf. Market experience is crucial in the selection. The right market knowledge and experience can help you achieve wonders through direct stock investments. You would also need to conduct extensive research before making an investment. If your market awareness happens to be sporadic and infrequent in nature, it is better to leave the selection in the hands of someone who has done their research. Stock investment warrants you to be an active market participant. Meanwhile, mutual funds are a great option for passive investors. And, equally important is portfolio diversification. Diversification reduces risk and balances the investment portfolio. Well-diversified portfolios can ride past market turbulence and help investors grow their assets. Experts recommend a basket of 10 to 15 stocks across different sectors for the ideal market diversification. This also helps the investor gain exposure across multiple domains. Mutual funds offer a better exposure with options to invest across multiple stock equities with a much lower investment. In comparison, stock equities present the option to choose the exact preferred options. Trading time. Equity stocks can be traded during exchange trading hours from 9:15 a.m. to 3:30 p.m. Traders can opt to choose the current price or set limits to leveraging maximum gains. Mutual funds can be purchased or sold only one time throughout the day, after the finalization of the NAV. Tax advantages. ELSS is a special type of mutual fund offering an option for saving on taxes. Under Section 80C of Indian Income Tax Laws, ELSS investments facilitate tax savings of up to Rs. 1.34 lakhs per year. Equity stocks do not provide any options for saving tax as such. When should you invest in mutual funds? Both stocks and mutual funds have their own set of merits and demerits. Traders always weigh in on the available options carefully before making an investment. The golden rule of equity stocks is conducting research diligently and making the right investments at the right time. Mutual funds offer a relatively easier approach, ideal for beginners, allowing them to bypass the hassles of analysis, stock pickup, timing, tracking, and managing their investments. The entire process is handled by a fund management expert. Other considerations: STG taxation and costing. Individuals are liable to pay 15% short-term capital gain (STCG) taxes for selling stocks before a year from the purchase date. Traders investing in mutual funds can avoid taxation by holding over a year. Interestingly, mutual fund organizations are not required to pay taxes. In terms of cost, investors can opt for lump sum or SIP investment plans in mutual funds starting at low prices. A similarly diversified portfolio across stock equities will cost much higher in stock equities. So which is the best option? As explained, there is no right or wrong answer in choosing between mutual funds and stocks. Depending upon the budget allocations and requirements, a person can select mutual funds over equities for the purposes mentioned in this video. Remember, stock returns tend to be risky and volatile, but also provide greater returns in general. That's all for today. Follow the next video for more updates. If you have liked our content, don't forget to like, comment, or subscribe. Hit the bell icon for future notifications.